Welcome back to another video. Today we'll be talking about what is the stock market. The first stock exchange in the world was created in Amsterdam when the Dutch East India Company was the first publicly traded company. To raise capital, the company decided to sell stock and pay dividends of the shares to investors. Then in 1611, the Amsterdam Stock Exchange was created. For many years, the only trading activity on the exchange was trading shares of the Dutch East India Company. At this point, other countries began creating similar companies, and buying shares of stock was popular for investors. The excitement blinded most investors, and they bought any company that began available without investigating the organization. These days, this scenario is commonly referred to as stock market bubble. This resulted in financial instability, and eventually in 1720, investors became fearful and tried to sell all their shares in a hurry, and so the market crashed. Another financial scandal followed in England shortly after, the South Sea bubble. But even though the idea of market crash concerned investors, they became accustomed to the idea of trading stocks while keeping the risk of the market in mind. The concept of trading goods, which laid the foundation from where stocks were first created, dates back to the earliest civilizations. Early businesses would combine their funds to take ships across the sea to other countries. These transactions were either implemented by trading groups or individuals for thousands of years. Throughout the Middle Ages, merchants assembled in the middle of a town to exchange and trade goods from countries worldwide. Since these merchants were from different countries, it was necessary to establish a money exchange so trading transactions were fair. As mentioned, Antwerp or Belgium today became the center for international trade by the end of the 1400s. It's thought that some merchants would buy goods at a specific price, anticipating the price would rise so they could make a profit. For people who needed to borrow funds, wealthy merchants would lend money at high rates. These merchants would then sell the bond backed by these loans and pay interest to other people who purchased them. The stock market works by pairing buyers and sellers who want to trade financial securities and helping facilitate transactions. Or, in other words, a stock exchange or stock market is a physical or digital place where investors can buy and sell stock or shares in publicly traded companies. The price of each share is driven by supply and demand, as well as investor sentiment and domestic and global economic trends. Investors need to know that they are willing to pay for a security and what a seller is willing to sell it for. There are spreads between those two prices, but in the end, if the two come to an agreement, securities trade hands. The US stock market is volatile too. The more investors want to buy shares, the higher the price goes. When there's less demand, the price of a share drops. Prices or values of securities are almost always in a flux, even when the markets are not officially open for trading. And for as how the investors make money, generally through asset appreciation, which is when an investor buys a security, that security increases in value and then is sold. As such, investors can make money off of stock market fluctuations. And you might ask, what are stock market indexes? A stock market index measures the performance of a certain portion of subset of the overall market. Speaking of markets being up or down, stocks and market can fluctuate on any given day. The US stock market has historically gone through larger market cycles in which the market expands and shrinks over the course of weeks or even years. There are typically four stages to a market cycle: accumulation, markup, distribution, and the markdown. The accumulation phase happens when a market is at a low and buyers begin to snap up stocks at discounted prices. At the beginning of the markup phase, prices have been stable for a while and more buyers start jumping on the bandwagon, driving up the stock. At the end of this phase, as buyers jump in en masse, the market makes a final spike as it is near the top of a bubble. During the distribution phase, sentiment becomes mixed, and in the markdown phase, prices typically plunge. During the decade long roaring 20s, speculators made leveraged bets on the stock market, inflating prices. The rise in share prices was followed by the stock market crash in 1929. Share prices took years to recover. Second, corporate buyouts and portfolio insurance helped prices in the market run up until October 19, 1987, what became known as Black Monday, among stock traders and investors. Panic selling, along with computerized trading, caused the Dow to fall 23% in a single day. Third, investors flocked to technology stocks during the internet boom of the late 1990s and the early 2000s. However, some of these companies weren't profitable and didn't have promising business models, causing the bubble to burst until 2002. Fourth, a rapidly growing housing market, along with the proliferation of mortgage backed securities in the financial sector, helped cause years of stock market gains in the early 2000s to 2008. The market then crashed, leading to a deep recession. Shares didn't start to recover until March 2009. Today, investors enjoy access to a robust array of different market and types of securities, and technology has made it possible for investors to trade online or even right from their smartphones. Some of the largest stock exchanges today consist of the New York Stock Exchange and Nasdaq, both in New York City, USA, the Shanghai Stock Exchange from China, the Euronext from European Union, Japan Exchange Group from Tokyo, Shenzhen Stock Exchange from China, Hong Kong Stock Exchange, National Stock Exchange of India, London Stock Exchange. There are three main reasons why stock markets are important. The first reason is that it allows companies to raise capital. Companies issue shares of stocks to raise money from investors to fund their business operations, expansion plans, R&D. Investors buy shares of stock in companies and earn returns through capital gains and dividends. This is a key way for many investors to generate wealth and income over the long run. The stock market also helps direct money and investments into innovative and growing companies. This improves the overall allocation of resources in the economy. Investors can put money into promising companies and then use it productively. Thank you for watching the video. Like and subscribe for more.